Stock market is not built by luck. You don't need to be the smartest person. You don't need to predict the market. You need to follow a system. Let me tell you the truth. Success is a mechanical result of the right actions repeated over time. It is a mathematical inevitability for those who stay the course. Step 1. Stop chasing quick money. Most beginners enter the market with what we call the lottery mind. They want the jackpot, not the process. They think, I will double my money fast, and that is exactly why they lose. They are playing a game of chance, not a game of value. Speed is the enemy of stability. Psychologically, the pain of a loss feels twice as intense as the joy of a gain. This loss aversion drives people to make panic decisions that destroy their capital. The market rewards patience, not impatience. It is a machine that effectively transfers wealth from the active and emotional to the patient and disciplined. Step 2. Invest regularly. This is the mechanical advantage known as dollar cost averaging. It is the bridge between earning and wealth. Not once, not when you feel like it, but consistently, every month, every opportunity. This removes the crushing emotional burden of trying to time the bottom. Research shows that missing just the 10 best trading days over a 30-year period can cut your total returns in half. DCA ensures you are always present for the growth. To understand how fast your wealth grows, you must master the Rule of 72. It is a simple mental shortcut for exponential growth. Divide 72 by your expected annual return. The result is the number of years it takes to double your money. At a 10% return, your wealth doubles every 7 years. In 28 years, your initial seed doubles 4 times. That means your money becomes 16 times larger than when you started. That is the power of a system. Step 3. Buy strong companies. We don't buy symbols, we buy businesses. We look for analytical rigor and fundamental strength, not social media hype. Look for companies with growth and profit. Use the price-to-earnings ratio to ensure you aren't overpaying. A great company at a bad price is a bad investment. Seek an economic moat, a sustainable competitive advantage like a strong brand or high switching costs that protects profits from the competition. Go deeper. Estimate the intrinsic value, the true worth of a business based on its future cash flows. Buy when the market price is well below this value. Always leave a margin of safety. Buying at a discount protects your capital if your analysis is slightly wrong. It is the hallmark of the intelligent investor. Step 4. Control your emotions. This is the hardest part. The market is not a math problem. It is a mass psychology problem. This is where most fail. When the market goes up, greed takes over. When it goes down, panic sets in. Beginners are controlled by System 1, the primal emotional part of the brain. Smart investors engage System 2. They use logical, preset rules to bypass their own emotional triggers. They stay calm when the world is screaming in fear. Look at history. The Great Depression, the 2008 crash, the 2020 pandemic. The market is a resilient beast that has survived every global catastrophe. Every single crash in history has been followed by a new all-time high. The only people who truly lost were those who sold at the bottom. History favors the holder. Step 5. Protect your capital. Rule number 1. Never lose money. Rule number 2. Never forget rule number 1. Capital is your oxygen. Avoid the big losses that reset your compounding clock. Remember, a 50% loss requires a 100% gain just to get back to zero. Protection is as important as growth. Stay within your circle of competence. Only invest in what you truly understand. If you can't explain the business to a child, don't put your money in it. Step 6. Think long-term. This is the most powerful force in the universe. Compounding, the 8th wonder of the world. Give it time. In the early years, growth feels slow and invisible, but the real magic happens at the end of the curve, where the annual gains begin to dwarf your total life's work. Never interrupt compounding. Reinvest your dividends. Between 2004 and 2024, reinvested dividends more than doubled the returns of the major indices. Reinvested capital is a force multiplier. Time is your most critical variable. Starting 10 years earlier can double your final wealth, even if you invest less total capital. The best time to start was yesterday. The second best time is now. From my own experience, I lost money when I was impatient. I lost money when I followed the crowd. I lost money when I didn't have a plan. I was my own greatest enemy. But everything changed when I became disciplined, when I stopped looking for action and started looking for value, when I stopped trading and started investing. If you want to build real wealth, focus on consistency, control your emotions, invest in quality. These are the 3 pillars that support every great fortune. Give it time. Because in the end, wealth is not built by chance or luck. It is built by decisions. It is built by the system you choose to follow today. Choose wisely. Your future self is watching. If you want to learn real investing and avoid the costly mistakes that destroy portfolios, Subscribe to Wealth Entertainment 21 now. Your journey to mastery starts here.